I've often wondered, why do some people retire with financial freedom and other people seem to struggle despite making similar money before they hit retirement? So, this is the series that I created called The Financial Fountain of Freedom. And I help investors achieve financial freedom by creating streams of tax smart income while growing equity for future generations. Hey, everyone, my name is Brad Reed. And I would like to encourage you to be good. And by good, I mean get out of debt, achieve your financial dreams, and give generously to your community. I am joined by Bijan Mirpur. He and I opened up an investment fund because of what we have discovered that we now call the Financial Fountain of Freedom. And we have Deanna Lee here joining us. She's going to talk here in about 40 minutes to share a class that she has that is for free coming up this Friday, February 13th. The agenda for today, I'm going to talk about something so scary that even Hollywood has not made a movie about it. It's called inflation. So if you have kids or I don't know, some household pets, maybe even some appliances, this may not be appropriate for it because it's going to be pretty scary if you don't know how to plan for it. I'm going to ask a very simple question that's going to reveal your financial destiny. Some people may be shocked or offended. Man, I'm not setting this up very positive, am I, Bijan? But it will end with an inflation adjusted retirement calculator that I'm going to gift to you for free. I created this first in 2015, recently came back and cleaned it up. But this will let you know what rate of returns you will need to seek based on your current situation and inflation and what kind of retirement you want to have. You can determine what rate of return you need to. Next time, I'm going to talk about Ray Dalio's Holy Grail of investing. Ray Dalio is easily the most successful investor of our time, maybe of all time. I'm going to talk about Peter Mallouk's asset allocation, and then I'm going to show you how I combine the two, and then let you do that as well. So when I said get out of debt, let's see, when I said I want to encourage you to be good, I meant get out of debt, right? That's going to be tier one of the program that I am building. Tier two is control your mind, body, and spirit, because ultimately you are the average of your five closest people. And you need to be sure who those five closest people are, right? If anyone's had kids, you're probably always asking your kids, who are your friends? Because you know that they will become the five closest people. Tier three is achieve your financial dreams, right? Invest for success. Learn to invest for yourself, whether that's passive or active. Build businesses, grow many streams of income so you can achieve your financial dreams. And then give generously to your community. I want you to live your dreams. And I know a lot of people who are very, very financially successful, but they do not know how to live like they are financially successful. So do what you want when you want. Become an owner, not an operator. Make money while you sleep. And folks, the happiest people on this planet are not ones that are the wealthiest. They are the ones that give the most. So if you want true fulfillment, learn how to give in a sustainable manner. All right, this is not financial advice. This is education and entertainment only. Should you need personalized financial advice, seek a competent and preferably licensed individual in your area. I am going to talk about a live deal, an active deal that Bijan, Deanna, and I are all doing together. This is not an offer, okay? There are no offers here. There will be a PPM that defines the offer. So, yeah, we're just here for education, maybe some entertainment along those lines. Last time we talked about how long does it take for your money to double. I talked about the rule of 72, which basically says 72 divided by the interest rate is the number of years it takes for your money to double. I'm going to bring this back here in a little bit. The first example was at 7% because this is what a lot of 401ks, IRAs, financial advisors get over a long time, okay, 20, 30 years. 72 divided by 7% means your money will double about every 10 years. The second example, I use 10% because this is the long-term stock market average. Long-term stock market average. 72 divided by 10% means your money doubles about every 7 years. Then the third example I used was 15% because that's what it takes for your money to double about every 5 years. Technically, it's 14.87%. We'll call that we'll call that 15%. And here's why interest rate matters. A lot of financial advisors, a lot of people that can only get you the blue or the red line, they say you got to get more time. So if someone has a time machine and we can go back in time and invest together, please let me know. Let's go do that. But I do not know how to create more time. I do know how to get a higher interest rate after 15 years of studying this. So that's what we are sharing in this series. All right, last time we talked about you can eat or you can plant sunflower seeds. And if you choose to not eat them but plant them, a sunflower seed will grow to a into a sunflower that makes 60 seeds in about 60 days. And if you keep compounding, if you keep planting those seeds, eventually you will have a ginormous sunflower farm. You will have an abundance of sunflower seeds, and we might call that uh, your financial fountain of sunflower seeds, right? You will have sunflower seed freedom. You will never want or starve for sunflower seeds again. So, how do we convert that to money? If it is before retirement, you reinvest everything and you will grow at what we call the annualized rate of return, ARR. Sometimes you'll see a MOIC, multiple on invested capital over a certain period of time. If you throw that into Chat GPT and say, hey, if I have a 5 year 2x MOIC, what is the ARR? And it'll tell you 14.87%. That's before retirement. If you are in your retirement, you can invest in some of these assets and they will give you a cash on cash return that you can spend responsibly. And then there will be an equity at the end of the investment, and you can reinvest that equity to grow your cash on cash return during retirement. All right, I got some questions since the last time. I got two of these questions. Why did you use $100,000 for your example? Basically, that's the fund minimum for right now. Every deal that you get is going to have minimums. And the reason they have minimums is that we have really big legal fees to set these things up. For our fund, we paid a lot of money to get it set up, and we have a lot of money that we pay monthly. And to offer you these investments, we have fees that we need covered, right? We could just go do these ourselves. In fact, we do invest in these things ourselves, but to bring you along, the lawyers have to get paid. It's also a communication issue. If we are doing a $20 million raise and we bring people in at $100,000, that means we have 200 investors to communicate to keep up with, to make sure that they're getting what they need. That's a lot of work. And it takes more time, it takes more energy. So a lot of the minimums are set appropriate for the size of the deal. Another reason we chose 100,000 is that if you are accredited and have $1 million in savings, that means that one deal is no more than 10% of your life savings, right? So we don't want you to get more than 10% into any one deal unless you're very sophisticated and you choose to, but 10% is a good number. It's enough where you can be diversified and uncorrelated. It's also not so small that investors fall asleep. You're going to keep up with what you are investing in. Another question I got is what is accredited? I believe is the way it was pronounced. Accredited is a government definition of a sophisticated investor. The government has these rules that say if you qualify, you are sophisticated enough to know what you're getting into. My guess is that right now, to be accredited, you need $1 million in net worth, not including your house, or $200,000 per year in income if you're single, $300,000 per year if you're married. These standards were set in the 1980s, and they have not changed since then, according to what I've been told, but they can change at any time. So here's another thing that you want to be pay attention to if you are not accredited now. President Trump in his first term tried to change this definition of sophistication to taking a test, because I'm sure we all know some millionaires that are complete idiots. So pay attention. If there is a test, it makes it easier for you to become accredited. And for the sake of time, I won't talk about what I think that'll do to the stock market. All right. Another question I got, you're not going to like the answer. What type of entity do I need if I want to be an LP? LP stands for limited partner. And it means if you want to limit your liability, meaning that in case of a lawsuit, you don't want to get sued or you don't want your other assets at risk, We all have complex entity structures to keep our personal assets from being at risk in the case of a lawsuit. Unfortunately, I have to tell you to talk to your lawyer. There are lawyers that scan videos like this and just sue people for saying things that they're not supposed to be sued. But I can say that I have many LP positions myself, limited partnerships, and I am not worried about being sued on those. And so I do have entities, but they're not really complex structures to protect myself from being sued. Hope that answered your question a little bit. There was a follow on that says, hey, look, I want to avoid probate. So, in case I die, how do these partnerships get passed on to my heirs? Again, you got to talk to your lawyer. I just am not allowed to talk about this publicly on a recording and put it up on YouTube. But I can say that every deal is a little bit different. And there was a deal that I almost walked away from because the deal said if I die, my shares go to the other surviving owners. And I said, no, 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 no. You change that so that if I die, it goes to my heirs, or I can transfer it into a trust. Talk to your lawyer, read the fine print on every single deal. All right, just a summary of last time. Question for you. If you have a hungry child in front of you and you have sunflower seeds, what are you going to do? Type it in the chat pane. Hey, Cheryl, welcome. Thanks. Cheryl, type something in the chat. I'm watching the chat pane, y'all. Y'all can type in. Maybe everyone's scared they're going to pick the wrong thing. It is a dilemma. Deanna says, feed the kids. So if you feed the kid, you have a happy child and they have food. And how hard is it to say no to a hungry child? If you do say no to that hungry child, you can plant your sunflower seeds and you can grow your sunflower farm, but you do have one very upset child. Thank you, Dennis. Thank you, Deanna. And if you can wait for some time, then you can feed lots of hungry kids in the future. My personal calling is to plant about 10% of the sunflower seeds, to give sunflower seeds so that someone can eat about 10%, donate 10% to charities that I believe in, and invest the rest. And at some point, we're going to talk about charitable foundations and how you can buy some of these investment assets and put them into charity, and then have that charity feed lots of hungry children, donate to St. Jude's sick children, or whatever the charity is of your choice. But there are heartbreaking decisions coming up. Yay! With great power comes great responsibility. Yes, I just quoted Spider-Man. All right, inflation. Let's get into the scary topic number one. The technical definition of inflation is Deanna qualifies. Yeah, I know what you meant, Deanna. Deanna, I've been investing with Deanna for, gosh, almost about a year and a half now. Inflation means your money buys less over time, right? The value of the dollar typically goes down a little bit every year. So what are we going to do about that? So if a time traveler were to come from the past to modern day and drive a taxi, you might say, why does it cost to put $1.50 to put air in the tires? Well, that's inflation because it used to cost a quarter. How come it costs so much more now? Man, I know y'all are laughing because this is one of the funniest jokes that I've seen in a long time. But here's a better example. Here's a menu from McDonald's from, I think, the 1970s, maybe the 1980s. I remember when my dad would take me to 2J's restaurant after school, located at 38th Street in Lamar, in Austin, Texas. And a cheeseburger, fries, and a Dr. Pepper would cost about $2.78. My dad would pull out $2 and he'd pull out the quarters and the nickels and dimes and the pennies and pay $2.78. And I remember how surprised he was when one week we went in and it was $2.83 because inflation. When I first got a car and started driving myself through the drive-through, it was about $5.50 for that cheeseburger, fries, and a soda. When I had kids and was taking them through the drive-through, it was about $7 and change. Now it's what, $11, $13 because the money buys less over time. So how do we plan for that in retirement? Inflation feels like the cost of goods and services increases over time. And the longer we get to retirement and the longer we are in retirement, that cost of goods is still going up. The government calls it the Consumer Price Index. And here's the kicker, folks. The government or the party in power gets to choose what they put in the Consumer Price Index. All that to mean that what is reported may not be what you feel when it comes to paying for your cost of living day to day, month to month, year to year. But typically it's food, housing, transportation, healthcare, clothing. What is in your personal CPI? For me, it's movie tickets. I remember when they were $4 and you had the $1 matinees. Now they're what, 12, $15 with the inconvenience fee they charge you to not pay it, not to buy tickets at the theater. Burger, fries, and a soda I just talked about. I remember when my dad used to take our family out for a nice dinner for four, $20 paid for all four of us, and there was change left over. So let's take this law of 72 and apply it to inflation. 4% is what I like to use for a long-term moving average of inflation. Now, different financial advisors may use the true mathematical average, but that mathematical average is going to go up and down over time. I want to plan for a 30, 40-year retirement or longer. 4% is my number. You choose what's right for you. But if you choose 4%, that means over an 18-year period, the cost of living will double. If you plan on being retired for 36 years, your cost of living will quadruple. You better make sure your retirement plans for the cost of living to go up 4 times during your retirement. All right, so what you need to know, what's the takeaway? Cost of goods and services, your cost of living goes up over time. Plan for it to double every 18 years. Folks, what this means, if you are not retired yet, every year you do not hit your retirement goal gets bigger. It's like running a race, but the finish line is constantly moving away from you. So you better run fast. The reason we're here today is that many of you are not running fast enough. I was not running fast enough when I figured this out 15 years ago. And I had to learn and study and join masterminds and learn painful lessons on what doesn't work so that I could learn how to run fast. I'm running fast now, and I want to help y'all run fast too. Run fast with me. Let's run fast together. If your rate of return is less than inflation, you are losing buying power. So if you still have some of these savings accounts or maybe CDs or treasuries that are paying 1% a year, 2% a year, you're losing buying power. What do you get in your retirement accounts? And ultimately, what I'm going to help you answer today is what rate of return do you need to hit before you retire? And if you are retired, what rate of return do you need after you retire? I'm going to give you that number, going to give you a calculator so you can calculate it. All right, going to ask you a question. Need you to clear your mind. Take a deep breath. We're going to play that game where what's the first thing that comes to your mind? I would appreciate it if you will share it in the chat pane. Jenny, you get to do this too. Jenny said she wants to listen in while she's doing some things around the house. So Jenny, go get to the chat pane. Going to ask you a quick question. Everyone, the game is not the right answer, not what you wish is the first thing that comes to mind, right? What is the first thing that comes to your mind? So take a deep breath, clear your mind, get your pen ready, get your fingers ready on the chat pane. I want you to answer this as quickly as you can because that'll be the most truthful answer. Here we go. What is the first thing that comes to your mind that you would do if you win $2 million? Go. What's the first thing? Type it in the chat pane. Let me see what you got. Oh, Sam. Jenny. Dave, thanks for that. Now, a lot of y'all are here because Anna says, completely funded deal. Anna says, go to a lawyer. That's not a bad one. Here are the numbers and how it works. Now, you guys are clearly ahead of the game. 75% of people that answer this question are going to buy stuff. They're going to buy cars, houses, toys, or they're going to buy amazing experiences and trips. They're going to give extraordinary gifts, life-changing gifts to people, and it's a beautiful thing. 20% of people that answer this question, they're going to pay off debts, they're going to invest in mutual funds, they're going to otherwise seek safety through savings. 5% of people, they're going to build or buy a money machine and they are going to print cash. And then they're going to take that cash and they're going to buy more money machines and print more cash, right? Going to buy businesses like apartments, like gas stations, um, like short-term rental portfolios, okay, like doctor's offices. They're going to buy these things that pay cash on cash and grow equity to outpace inflation. Then those people are going to use the cash on cash to buy their toys to pay off their debts. Now, here's the part I want everyone to take a deep breath because I'm going to make some of y'all mad. Okay. But it's a painful truth that I had to learn because I used to dream about buying stuff, giving gifts, like paying off the church mortgage was always a big thing I wanted to do. I still want to do that. But if your first thought when you get money is to give it away, it's basically a low net worth money mindset. My son had some friends over the other day, and they were all playing video games. And it turns out one child at 12 years old had spent $5,000 on this one video game, like character add-ons. I don't know what they spend their money on, but a 12-year-old had spent $5,000. Imagine if he had invested that $5,000, that would be over $100,000 by the time he retired, and he could get a share of a short-term rental portfolio that pays amazing returns. You got a middle net worth money mindset. If your first thought was to pay off debts, you have a high net worth money mindset. If your first thought is to buy businesses and to invest it in things that will, um, yeah, Jenny says the first time she saw $5,000 was at work. That's what inflation does, right? These kids these days, they have access to $1,000, some of them. At any rate, if your first thought was to buy stuff, want to work on your money mindset. Just think about anytime you dream about winning the lottery, what will you do? Shift yourself towards the bottom. And folks, I've got to move on because I'm running short on time. The reason we have a big problem in our society, I heard someone report the other day that the difference between the have and the have-nots is all is the worst that it's been in over 200 years. Think about that. Let's go back to the early 1700s and 1600s. And when you read about medieval times and the Renaissance and all that stuff, the difference between the have and the have-nots, we're approaching that because people today, as soon as they get a dollar, they give it to someone who owns a business. As soon as they win the lottery, 90% of people that win the lottery file bankruptcy. Did you know that? Because as soon as they get the money, they give it to someone who owns a business. So buy the businesses, get the money, and then use it to be responsible. And like Deanna wants to do, help feed hungry children. All right, here's an example. I had a cousin, this was a number of years ago. The goal was to buy $100,000 car. I see my mom and dad are in the chat pane. Don't sell out the cousin. All right, don't put the name in the chat pane. But this is a true story. This cousin, the goal was to buy a $100,000 car. So option A, you marry someone who has $100,000 in cash and you go buy a $100,000 car. Well, in 5 years, your $100,000 car might be worth $50,000. And in 10 years, it's ugly and it's not worth anything. And you are out $100,000, maybe only $95,000. Option B, you invest $100,000 and you use the cash on cash return to pay for your car expenses. So a typical deal, and this is in the previous video, you can go look at it. A typical deal would have 10% cash on cash return and a 2x multiple on invested capital. Spoiler alert, that's a 14.87% annualized rate of return. But 10% cash on $100,000 will give you $10,000 a year for your car payments. That's over $800 a month. That'll buy a nice car. That's a lot of Uber rides or taxi rides or whatever you're doing. In 5 years, you get to upgrade your car. because your deal is done. And after you spent $10,000 a year, your $100,000 grew to $150,000. I walked through this example in the last video. Go watch it if you don't remember the math. But you reinvest at 10% cash on cash. Now you have $15,000 a year for your car payments. That's what, $1,200 a month? That's a nice car. Guess what? In 10 years, you get to upgrade your car again. And now you're spending almost $2,000 a month on your car payment. Now, evidently, based on the answer that y'all put previously in the chat pane, y'all are not spending all of that on a car. You're using some of that money to go get more investments, more money machines. You're replanting your sunflower seeds. You're growing your farm. You're getting more fountains of financial freedom. So I hope I have illustrated to you that option A, you are a victim to inflation, because not only is your $100,000 gone, but to buy the same kind of car 10 years later, you now need $225,000. Or maybe in 10 years, it didn't double. That would be a really high rate of inflation. Let me rephrase that. You probably need 140,000 to buy that same car 10 years later, maybe 160. But your money's gone. You got to come up with more money. You're a victim to inflation. Option B, you are outpacing inflation. So if you are retired, notice how your car payments, change that to your lifestyle payments. Notice how you can improve your lifestyle throughout retirement with strategy B. All right, so what rate of interest rate do you need? We're getting to it, and it looks like I'm doing good on time. So Deanna, think about 5 minutes more. The typical strategy that Americans are taught is before retirement, grow your stocks, ETFs, or mutual funds as fast as you can, as long as you can, invest as early as you can, scrimp, sacrifice your lifestyle because retirement is scary because they don't tell you about inflation because you just can't handle it. It's too scary. It's worse than rated R. Once you retire, you hope that you have acquired enough crap that you can sell it and live off the proceeds. But remember inflation. So you still need to grow your accounts more than inflation, and then you can sell the rest. And if you have down years, you're in trouble. If you are all in public equities, you're 60% correlated. And if the stock market goes down, your whole account goes down because you're 100% or you're 60% correlated, and you're probably not diversified enough. The strategy that Indomitable Horizons is bringing, the one that I have been working on, the one that I have built for my family, the one that Bijan has built for his family, Deanna, and some of you in the chat pane are building, and some of y'all are investing with us. So thank you so much for that. You build and you buy cash flowing businesses. It's harder to build them than it is to buy them, but well, it can be less expensive. We'll go into that later, but you are building your financial fountain of freedom. After retirement, you live off the cash flow, you grow your capital, you reinvest the equity to outpace inflation and leave a generation changing inheritance to your youngins. Be diversified, non-correlated, look for asymmetric risk reward, and get different asset classes for steady cash flow and increasing cash flow. If you want to be passive on the typical strategy, it's going to cost you 1 to 2% of annually, whether you win or lose. And for this reason, your financial advisor, over the course of about 25 years, will end up with more money than you do. Because when you take losses, your financial advisor is still getting paid. I was shocked when I found out about that. I was shocked a lot about things when I was a financial advisor with my 6, 63, and 65 licenses. There's a reason I don't do that anymore. Now, if you want to do this bottom strategy, it can cost you somewhere between 5 to 20% of the payouts, but only if there are payouts. You also have to deal with all the education, the underwriting. You have to connect with trustworthy operators. You have to do background checks. You have to do interviews on the operators. You have to know what to look for. You have to learn the stuff that I've been learning over the past 15 years. Bijan and Deanna have also spent decades learning this stuff. Maybe you can learn it faster. I will certainly shortcut your route. That's why I'm creating these videos. Let's move on. So I am going to gift you my inflation adjusted retirement calculator. If you are not accredited yet, you are probably going to be on the sell your stuff strategy, the SYS tab. So in this case, you want to enter your situation in the yellow boxes in the upper left. So in this case, I put what is the current year, what year will you retire, and this next box is if you were retired today, how much annual income would you need from your retirement savings? So I picked a pretty luxury lifestyle. Maybe that's not luxury to you, but $200,000 per year if you were retired today. What rate of inflation will you plan for? You get to pick and choose whatever you want there. I put 4%. What rate of return will you seek during retirement? I think most financial advisors will tell you 6%. What rate of return will you get before retirement, right? While you're still working, I believe most financial advisors will give you 8%, but you get to pick and choose. If you disagree with me, put whatever you want in there. And let's say you currently have $1 million. So if you have $1 million and you still have 14 or 15 more years to work, and you're shooting for $200,000 in today's money, we'll see what that takes. So after you put your information in the yellow boxes, analyze what monthly contributions you need in order to hit that goal. Notice that situation that I just described, you need to come up with $47,000 monthly if that is your retirement goal in current situation. When I found out about that, I'm like, that's a lot of money. I got to figure out a way to invest better. So the next step is to look at the numbers down here, how inflation is going to affect you. And the big takeaway here is if you want $200,000 now, and what $200,000 will provide in 2026, it'll take $360,000 to provide that same lifestyle in the year 2041. Experiment with different interest rates to determine what is right for you. Now, if you want to try the Indomitable Horizon strategy, it's going to look a little bit different. You still enter the current situation in the yellow boxes. A couple of boxes are going to change. This one says, during retirement, what cash on cash returns will you seek? During retirement, what equity growth rate will you seek? And before retirement, what annualized rate of return will you earn? I picked numbers here that I think Bijan and I can get for you. Okay? No promises. No projections are never guaranteed, but I think we can get you that. So if you have $1 million, you do get these returns, and you want $200,000 in today's money, you don't have to put in anything. Notice how $47,000 a month on one strategy becomes $0 a month in the other strategy. And instead of retiring in 2041, you can retire in 2039, 2 years earlier. May not sound like much, but I think, 2 years out of 15, that's a pretty decent chunk. So it is almost time for you to get to play with the calculator and for you to get your returns. But before I do that, I'm going to let Deanna come off the mic, and she's going to talk about a deal that we are currently raising on. Now, we're going to talk about the deal. We're going to talk about projections. These are only projections. They are not promises. This is not an offer. If you do want an offer, you got to reach out to us. We have contracts that define the offer. This is not an offer. So the typical apartment deals, if we are running it for you, you can put these in the calculator. You're going to be looking at about a 12.5% annualized rate of return, 8% cash on cash, 6.9% annualized equity growth. If you are a passive investor in the destinations deal, these are your numbers: 37% ARR, 19% cash on cash, 13.8% annualized equity growth to put in your calculator. Folks, these are projections. These are not promises. There is a lot of discussions we need to have before you can invest. If you are accredited and you want to learn more, use that information to set up a meeting. If you are not accredited, please leave the time on our calendar. We do have $1.5 million left to raise. Give us the time to do that. There will be opportunities. I am opening up calendar time in the future to talk with you. Deanna, your turn. Will you tell us about how you're going to teach everyone what you know for free coming up this Friday, February 13th at 11 a.m. Eastern?
Yes, thank you so much. Can you guys hear me?
We can hear you.
Awesome. So thank you, Brad and Bijan. Great presentation. I am Deanna Lee, and I specialize in short-term rentals and luxury experiential hotels and glamping retreats. So if you've been building in real estate and you're wondering what that next level actually looks like, I want to invite you to something really special, and Brad's going to be there with me, and Bijan as well. I'm hosting a masterclass called Unlocking Your Magical Ability to Create Wealth in Real Estate. It's the buffet of real estate. So whether you're interested in long-term rentals, short-term rentals, apartment buildings, all of everything there is in real estate, we're going to give you a taste of everything. And what we're going to do is I'm going to walk you through the full ascension path that I took from long-term rentals to short-term rentals and ultimately into the luxury experiential hotels and retreats that I love. And not just what sounds exciting, but what actually works, what moves the needle, the challenges, the pitfalls, right? All those things along the way that nobody talks about. As you can tell, Brad and I like to talk about those because they're real. And I'm going to show you how to shorten the time spent in what I call the messy middle. So we'll talk funding clarity, so you'll understand exactly how to buy the property, what lending options are available. Brad's going to show us how to determine that freedom number, which he just showed you, and that was so cool. Now, how to raise capital properly if you need to bring on investors. We'll cover scaling without burnout. We have an AI expert who's going to teach us how to use systems so that you can strategically focus and not add more chaos, right? We don't want to build another job. And then we'll explore luxury experiential assets, my favorite, the boutique hotels, the micro resorts, the glamping retreats, and why those things can accelerate the income and the lifestyle, just like Brad was speaking to, how we can accelerate that income and keep the lifestyle that you want and do it intentionally. So you'll know how to buy, fund, and scale real estate with clarity by the end. So if it sounds intriguing, I'd love to see you there. I'll put the link in the chat for you guys to
Bijan
sign
beat you
up.
to it. The link is
And
in the chat.
what's that?
Bijan beat you to it. The link is already in the chat.
Very good, very good. Yep.
And
So that's it.
Deanna,
We'd
how
love to
much
see
does
you
it
there.
cost?
And you will walk away after this 4 hour masterclass. You will walk away with actionable items that you can implement right away. And we'll have the different pathways, like Brad mentioned, between investing and being passive or through education. We are here to provide value and provide clarity.
Awesome. Thank you, Deanna. Uh, I don't know if Deanna said it, but it is free to sign up, but you do have to sign up. It doesn't just happen. Um, and one thing that I really love and I'm excited about Deanna's deal is she's going to tell you how you can do it and be passive. So give you education so you know what you're investing in. And then if you want to be active, she's going to help you do that too. Okay. And Deanna, I did put it up there. My second largest investment is with Deanna. It's in this deal that's on the screen. All right. Type those numbers in, write those numbers down on the left. If you need them, I can help you. There's the link. All right. So you can go get your calculator right now. I think I just typed it in the chat pane. Uh, Maybe Bijan can go to a web browser and put a live link. But Deanna's class is on Friday at 11 a.m. Eastern time. If we didn't say that, there is the calculator. We can go play with it. Actually, let's go do that now. Ooh, one thing that I forgot to mention. The calculator, and I don't even have it pulled up. That's not good. Let's see, is this it? Nope, that's not it. So y'all are going to get to see all of my list of Google documents. There it is, retire calculator. All right. So eventually, oh no, I got to kill that. You're going to hear a ding every time one of y'all gets the calculator. Okay, so this is a shared file. This is a document, shared document. So come up here to File, select Make a Copy if you want your own. Uh, Otherwise, we're all going to be changing numbers on top of each other. If you do corrupt your own calculations, then come back and get it again. But here is the example. You can come through here and you can change that to maybe you think you can get 9% before retirement and 8% during retirement. And you can change these numbers. And that means you only need $16,000. Maybe you're happy retiring on what is $100,000 today, and putting in $3,000 a month is perfectly reasonable. Play with the numbers. That's the whole point of this. Determine what rates of return you need. Now, remember, the sell your stocks, this tab is better suited for those who are not accredited. If you are accredited and you want to invest, click on this other tab over here, and then you can adjust these numbers over here. Now, if you are interested in Deanna's deal, before retirement, it grows at a 37% annualized rate of return. During retirement, the equity was it? Oh, shoot. What was it? I think it was about 13%. I'm going to put 13% there. I know the cash on cash return average is about 19%, but you can see if you have $1 million right now, and we would not advise that you put the whole giant thing in there. But if you wanted $200,000 in retirement income, you could retire next year. Thank you, Deanna. So a lot of people have dropped out of the webinar. Yeah, if y'all can't tell yet, I'm not doing sales pitches here. I'm kind of straight and honest. So sounds like people got their tool. They're having fun. Do you have any questions? Do you have any questions that we can play with numbers together? Type them into the chat pane if you have questions. I'm going to put this back at about 12.5%. And that one, where did I have that one in? Equity grew at, I think it was 6.9%, 6.9%, and cash on cash at 8%. And because I believe those are numbers that Bijan and I should be able to get. The market's changing all the time. Their projections only, no promises. No questions? All right. Most of y'all have my cell phone number. So you can reach out to me. If you're watching this on YouTube, leave a comment. I'll be checking in. Hit me up on social. I'm about to show you all my social media stuff. And yeah, you can, I will answer. Bijan's going to help me answer too. Okay. So as a review, inflation destroys your buying power. You outpace inflation or you lose your buying power. Investing matters. Your interest rate matters. Work on your money mindset. If when you dream about winning the lottery, you think about buying stuff, start working on changing that. It took me about 2 years to change my money mindset. That's another reason why you are the average of your five closest people. If your five closest people are spending money on stupid stuff, you will too. You will feel social pressure to do that. If your money mindset is on buying businesses, then that's what will motivate you. Calculate your desired rates of return, folks. Don't guess. You get one shot at retirement. Don't screw it up. Calculate the rate of return that you need, and don't sacrifice. If you need a higher rate of return, let's go get it. Let's invest in different things, different asset classes. Maybe you need to put in the time to be active, right? If you want higher rates of return and you need to be active, you will have to pay for courses. You will have to put in years and years to study, just like you did in college, right? College is expensive these days. Masterminds are expensive. Coaches are expensive. But once you're done, you can do it yourself or get a little bit lower returns, but you've got a pro doing it for you. And I'm not going to do the thing where you'll hear this from other people. If you're going to do brain surgery on yourself, do you want to do it yourself or do you want to pay a professional to do it? I mean, there's some truth in that, but I don't like scare tactics. Gosh, I guess I just did that. I just did scare tactics. All right. But investing for retirement is a lot less serious than brain surgery. So don't tell people they're being hyperbolic. Is that the right word? I don't know. I just made it up. Cool. Bijan just put both links back in the chat pane. Thank you, sir. Next time, Ray Dalio, the most successful investor I've ever heard of, I will share his 3 tips. He says be diversified, be non-correlated with asymmetric risk reward. Peter Maluk, spoiler alert, most did an asset allocation of the ultra rich. The largest holding was real estate, which is why Bijan and I like apartments, which is why Deanna is doing real estate as well. The next is private equity. That's businesses that are not on the stock market. The next smaller one is public equities that is on the stock market, then energy, then alternatives. And I will share all of those details with you next time. And I will share with you how I have combined the two. And then I'm going to show you the agenda for the rest of this webinar series, what I'm going to talk about, when I'm going to talk about it. But folks, thanks for joining me on this trip. Thanks for joining me on this one. Please stay tuned. If you have not registered for this and you want to see the rest of the series and you're watching this on YouTube or social media, check out the registration link that'll be in the description box and you can follow along. I am going to upload all of these to the same playlist, so one link and you get them all. Join me next time with my friends here. Folks, thanks for, seriously though, thank you for being here, friends and family. I really genuinely appreciate you taking your time to be with me here live tonight. Thank you for your participation in the chat pane. You know I love you. You know I want to help. So thank you. And as we go forward, always remember, trade on logic, not on hope. God bless you.